Life is full of surprises, and not all of them are good. That's where insurance comes in. It's like a safety net for when things go wrong. But what exactly are these things we're talking about? These things are called perils in the insurance world. A peril is simply an event that can cause damage or loss. Think of it like this. A peril is what that could happen. Let's say your house is insured. A fire, a storm, or even a burglary could be considered perils because they could damage your home or belongings. Each type of insurance covers specific perils. Your car insurance, for instance, protects you from perils like accidents, theft, or vandalism. Health insurance is there for perils like illnesses and injuries. Life insurance covers the peril of your untimely death, providing financial security for your loved ones. Understanding perils is the first step towards understanding your insurance needs. It's about identifying the potential risks you face and finding the right coverage to protect yourself and your loved ones. Remember, knowledge is power, especially when it comes to securing your financial future. Now that we've tackled the what, let's move on to the how of insurance protection. When you buy an insurance policy, it will either list out specific perils it covers or offer more comprehensive protection. This is where named perils and open perils come into play. Named perils coverage. Imagine receiving a menu listing every dish the restaurant serves. That's how named perils coverage works. Your policy will clearly state the specific perils it protects you against. For example, a basic homeowner's policy might list fire, lightning, windstorms, and hail as covered perils, open perils coverage. Now, imagine a buffet where you can choose from a wide variety of dishes. That's open perils coverage. It provides broader protection by covering all risks except those specifically excluded in the policy. This means you're covered for a wider range of events, even those you might not have anticipated. Here's a simple way to remember the difference. Named perils. Specific perils are named like ordering à la carte. Open perils, covered for most perils unless specifically excluded, like a buffet. We've discussed the potential misfortunes or perils that insurance protects against. Now, let's talk about the actual harm these perils can cause, the loss. In insurance terms, loss refers to the financial damage or hardship resulting from a covered peril. For example, if a fire damages your home, the cost of repairs and replacing your belongings represents your financial loss. Loss can be categorized in two ways. Direct loss. This refers to the immediate and obvious damage caused by a peril. Using the fire example, the charred structure of your house and the destroyed furniture are examples of direct loss. Indirect loss. This type of loss stems from the initial direct loss, but isn't as immediately apparent. After the fire, you might need to live in a hotel while your home is being repaired. The hotel cost is an indirect loss resulting from the fire. Another essential distinction is between accidents and occurrences. Accident, an unexpected and unintended event. A car crash is an example of an accident. Occurrence, an event including continuous or repeated exposure that results in injury or damage. Think of a slow leak that causes water damage over time. That's an occurrence. Section 4. Facing the unknown. What is loss exposure? Now, let's delve into a slightly more complex but equally important concept, loss exposure. Imagine a game of darts. You aim for the bullseye, but there's always a chance you might miss. Loss exposure is like that. It's the possibility of experiencing a loss. Every aspect of our lives carries some degree of loss exposure. Owning a home means facing potential losses from fire, theft, or natural disasters. Driving a car comes with the risk of accidents. Even our health is a form of loss exposure, as we could experience illness or injury. Understanding your loss exposure is crucial when deciding how much insurance coverage you need. The higher your potential for loss, the greater the need for insurance protection. This is why factors like the value of your assets, your health history, and your lifestyle choices all play a role in determining your insurance needs. Section 5. Strength in numbers, homogeneous exposure units. Have you ever wondered how insurance companies determine your premiums? It's not just random. They use a concept called homogeneous exposure units to assess risk and set pricing fairly. A homogeneous exposure unit is a group of individuals or assets facing similar risks. For example, a group of healthy 30-year-old non-smokers applying for life insurance would be considered a homogeneous exposure unit. They share similar characteristics that suggest a comparable level of risk for the insurer. Insurance companies gather data on large groups of similar individuals to predict future losses accurately. By grouping people with comparable risk profiles, they can calculate premiums that fairly reflect the likelihood and potential cost of claims within that group. This concept of homogeneous exposure units ensures that individuals pay premiums that are proportionate to their risk levels. It's all about spreading the risk among a group of people facing similar potential losses. Section 6. Beyond the obvious, unmasking the three types of hazards. We've covered perils, the events and losses, the consequences. Now let's explore the factors that can increase the likelihood of these perils occurring, the hazards. Hazards are like hidden dangers lurking in the shadows, increasing the chances of a loss. Think of them as the why behind the what. There are three main types of hazards. Physical hazards. These are tangible conditions that make a loss more likely. A slippery floor, frayed electrical wiring, or a dead tree leaning precariously over your house are all examples of physical hazards. Moral hazards. These are a little trickier. They arise from people's behaviors and involve dishonesty or a lack of integrity. Insurance fraud, exaggerating claims, or intentionally causing damage to collect insurance money are examples of moral hazards. Morale hazards. These hazards stem from carelessness or indifference to loss. Imagine someone who consistently leaves their car unlocked with valuables in plain sight. This careless behavior is a morale hazard that increases the risk of theft.